Jerome Powell, Fed just crashed the 2022 housing market. The astonishing 37% increase in U.S. home prices occurred in just 24 months. In contrast, the largest two-year increase preceding the housing crash of 2008 was 29%. This spring, the Federal Reserve made the decision that it had seen enough. The average interest rate for a 30-year fixed mortgage increased to 6% from 3.2% at the beginning of the year as a result of the central bank's quick increase in interest rates. The epidemic housing boom finally came to an end as a result of those higher rates, which priced out many homebuyers. We are currently experiencing a sharp slowdown, with mortgage applications down 16% on an annual basis, according to a report released by the Mortgage Bankers Association. We heard very little from the Fed during this shift, that is, up until Chair Jerome Powell's press conference. Three aspects stand out. What are these, and how is this going to play out? Stay tuned, as we got it all covered. Welcome back to another interesting episode in today's video, where we'll be talking about the upcoming market crash and how you need to be careful. Do make sure to like, share, and comment below, as it also encourages us to produce more valuable content for you all. If you have a specific topic you'd like to learn, please leave a comment below and we'll work on it for you. Let's dive in. Three aspects stood out, and they were: 1. Powell believes that home buyers need a bit of reset. The term inventory in the housing industry refers to the total number of active listings. Inventory levels have been dropping annually since 2014. That was influenced by various factors, including changing household preferences, such as settling down longer, lower levels of home building following the 2008 housing crash, and the emergence of millennial first-time home buyers. Inventory levels, however, started to decline as soon as the pandemic housing boom took off. Inventory will be at a 40-year low by spring 2021. Due to this, homebuyers have had no choice but to bid up home prices. It is obvious that Powell believes the slowdown in housing activity brought on by higher mortgage rates will aid in raising inventory levels. According to Powell, it will benefit buyers because the market will be friendlier when shoppers resume their search for a home. A lower likelihood of a bidding war would result from higher inventory levels, which would give buyers more time to make their decisions. Logan Mohtashami, the lead analyst at Housing Wire, was openly advocating for higher mortgage rates as a way to boost inventory levels even before the Fed intensified its fight against inflation. Housing supply in the United States increased slightly to 1.03 million as of the beginning of May, according to the National Association of Realtors. Mohtashami asserts that inventory would need to increase from 1.52 million to 1.93 million housing units in order for the housing market to return to normal. Over half of regional housing markets still have inventory levels that are 50% below pre-pandemic levels, despite the fact that national inventory levels are rising quickly. 2. Are home prices falling? Fed Chair Powell seemed to raise the speculative issue of falling home prices. Powell appeared poised to predict a decline in home prices for a brief period of time. Powell didn't exclude a decline in housing prices, though. That is significant. Year-over-year, home price declines are extremely rare historically, with the exception of the Great Depression in the years following the 2000s housing crash. But given the current situation, it's possible that home prices will fall for a brief period of time. It's telling that Powell didn't rule out the possibility of home price declines, instead saying, "We are watching that quite carefully." According to Mark Zandi, chief economist at Moody's Analytics, we have entered a full-blown housing correction as a result of raising mortgage rates. Zandi anticipates a rapid decline in the rate of annual home price growth from 20.6% to 0% in the near future. He anticipates 5% to 10% declines in home prices in significantly overvalued housing markets. In the event of a recession, Moody's Analytics forecasts a 5% drop in home prices in the United States and a 15% to 20% drop in significantly overvalued housing markets. By comparing a regional home prices to what local economic fundamentals like household income would typically support, Moody's Analytics was able to determine whether there was an overvaluation of the market. Why are house prices now prone to dropping? Starting with how detached home prices are from underlying economic fundamentals, we can see where this problem is coming from. According to fundamental economic theory, the rise in housing prices and the rise of household income are intertwined and cannot be outpaced for very long. The squeeze on affordability has only gotten worse as a result of rising mortgage rates. A real estate analytics company called Zonda claims that the average new mortgage payment has increased by 52% over the last 6 months. In order for home prices to decline, however, inventory would probably need to increase significantly. Motashami believes that once inventory levels in the United States exceed 2 million units, home prices would begin to fall nationally on a year-over-year basis. According to Ralph McLaughlin, chief economist at real estate data and analytics firm Kukin, if the Fed's over-tightening triggers a recession, inventory may reach levels that permit a decline in home prices. 3. Powell made it clear that he wanted to see mortgage rates decline. In order to stop the economic housing boom and contain the out-of-control inflation, the central bank increased interest rates. High mortgage rates may start to decline once the Fed has reined in inflation. However, home buyers looking for lower mortgage rates may have to wait a little longer. The Consumer Price Index was at 8.6% as of the prior week. As long as the CPI is below 2%, the Fed won't stop fighting inflation. The Fed made it abundantly clear that this conflict might continue well past 2024. The U.S. housing market is now the least affordable it has ever been in U.S. history due to these higher mortgage rates and record-high home price appreciation. As a result, buyers which are on strike and refusing to enter this greatly inflated housing market, which will have these two main effects as a result. For starters, inventory in the U.S. housing market will skyrocket over the next 3 to 6 months. You won't believe how many homes will be for sale but have no interested buyers. Second, there will be significant price and value reductions. While some of you may be uncertain, we forecast that the inventory in the U.S. housing market will return to pre-pandemic levels by November 2022, which is just 5 months away. In 2018, there are 18 million single-family homes owned by real estate investors in America, according to the U.S. Census Bureau. Today, that number is probably closer to 20 million, which is amazing given that investors own so many properties at close to 20 million. Only a small percentage of investors need to sell in order for the market to crash. For example, 5% of current investors selling their homes would result in 1 million new listings, more than doubling the amount of inventory currently available, according to Realtor.com. That's not all. In order to exit the market before prices decline, investors will be selling their properties at the same time. There will be a massive backlog of foreclosures. Since the pandemic was released onto the market, it has continued to grow. Additionally, 650,000 homeowners are currently in serious backlogs after failing to make their debt service payments for more than 90 days. These 650,000 people will soon be either subject to foreclosure proceedings or compelled to put their houses up for sale. This will continue to an increase in inventory. In addition to this, 1.6 million new homes and apartments are being built by U.S. home builders right now, despite delays brought on by the lack of labor and building materials. The delivery of these 1.6 million new homes and apartments will begin within the next 6 months, setting the stage for the biggest housing crash in American history. The Federal Reserve's tightening of monetary policy has caused mortgage rates to rise. But do you want to wait it out for lower mortgage rates? We believe that in the next 1 to 2 years, mortgage rates will crash because it appears that the U.S. economy is about to enter a recession. Every time there has been a recession in the United States, mortgage rates have fallen by 1% to 4%. Mortgage rates tend to fall during a recession because interest rates and treasury yields fall as well. And it's likely that at some point, as the recession continues and worsens, the Federal Reserve will stop tightening monetary policy and begin adopting a more accommodative one. With this, we have come to an end. If you have found this info helpful, please give a thumbs up and subscribe for more content like this, as it also encourages us to produce more valuable content for you all. If you have had a specific topic you'd like to learn, please leave us a comment below, and we'll work on it for you. Until then.